Hello, everyone, and welcome to the Buck Stops here. I'm Catherine Murray. Well, we have seen a number of retailers report their most recent results, and I wanted to delve into the companies and also really what the read through is for the broader economy. As we know, the consumer accounts for about 70% of the GDP, and how they're feeling, how we're feeling. Is very important as it relates to the economic outlook, what the US Federal Reserve may or may not do, what the Bank of Canada may or may not do as well. In other words, how is inflation impacting everybody? And therefore, where will we see rates go? That, of course, impacts the valuation of all asset classes. So that's kind of the big picture purpose here. But we're also going to, of course, get into some of the specific stocks and ideas for you in case there's a couple that you might want to look at. For that, Brian Madden is joining us. He's the CIO at First Avenue Investment Counsel. Brian, welcome and thank you so much for being with us.
Thanks very much for having me, Catherine.
So it was a bit of a long-winded way of saying why I want to look at the consumer stocks, and by way of background, you spent a lot of your career as an analyst covering those names, and I did way back when as well. But they really do tell you a lot about the consumer. So just big picture here, Brian, what do you think the read-through actually is from the results we've seen so far?
It's hit and miss, Catherine. There's companies beating subdued expectations. There's companies disappointing, and then some companies are still managing to power through and beat, admittedly sometimes lofty expectations. But I think the real bomb went off in the consumer land sometime in May when we saw Walmart a quarter ago with a pretty ugly quarter, one of the worst we've seen in decades. Target was not much better, and Amazon wasn't very good, reporting Q1 results. And so, I think that sort of reset expectations for a lot of the retail and consumer landscape. And so it's been sort of a mixed bag as we've gone through the Q2 reporting season. But yeah, broadly tying it back to the macro themes, Catherine, what we're expecting and what we're indeed seeing is a slowing economic climate. Some of these things are starting to bite consumers in the pocketbook, notably high energy costs and generally high inflation, food inflation. Rising interest rates are starting to cause pain on borrowers resetting mortgages, and so what we're positioning for here at First Avenue, and have been doing work on the investment team, is what we think of thematically as a consumer trade down. And so we're looking to the extent we own consumer names, consumer staples names, we favor over discretionary. And within the discretionary space, we favor sort of value centric retailers and retailers with exposure to the trade down theme, tighter purse strings than what we saw a year ago when everybody was buying a jet ski and a hot tub and a flat
Mhm.
screen TV, and, everything else.
Yeah, yeah, that's very true. So the trade down theme is always interesting when you go into an economic slowdown. And the dollar stores tend to be the ones that benefit the most. I guess, though, in some ways, you would think that Walmart would have been a little bit better positioned.
Well, yeah, Walmart, I think in Canada we tend to think of it as a general merchant, and it is, although there's grocery in a lot of their locations here in Canada. But in the US, it's very much a grocer. Grocery accounts for about half of their revenues in the United States. So, I think grocery is doing fine in sort of dollar terms, maybe in unit volume or tonnage terms. They might be losing a little bit of market share, but probably not too much. But where Walmart really stubbed their toe in the first quarter was on apparel and some of this more discretionary merchandise where they had to mark it down and kind of blow it out. I think their second quarter results came in stronger than expected, in part because they had reset expectations with that Q1 tape bomb that took the stock down a lot on the day they announced the results. But the other factor that's helping them is with half of that merchandise being groceries. Grocery has been a category that's very inflationary, and so that's been
Right.
passed through and fed into better than expected revenues for Walmart, at least in that part of the store.
Okay. So it really is an atmosphere right now that goes back to how we all invested originally, which is some retailers do well and some don't, as opposed to the U.S. Federal Reserve, really allowing so many assets to increase. We'll be right back. We'll take a short break. So, Brian, as I was saying, or trying to wrap up the previous segment, it's basically, over the past, well, since the financial crisis, you had the Fed at your back, right? I mean, there's so many stocks and so many different sectors you could buy, and the majority of them went up. We're in a much different environment now. You actually have to do your homework and figure out what stocks are going to go up and which ones are not because they've got their own, issues. Wouldn't you agree? I mean, it's actually a more interesting time to invest.
Well, yeah, it's more gratifying for people who are wired to do fundamental research, as my colleagues and I are here at First Avenue Investment Counsel. It's kind of frustrating when you see markets where, the Uber driver and the delivery boy is an expert, and the meme stocks are going up 300% a day, as we saw 4 or 5 quarters ago. And you're right, that's a function of free money sloshing around the system. You point to the Federal Reserve and the Bank of Canada with the liquidity taps wide open. That was indeed the case, and that floated a lot of risky assets, that weren't backed by solid fundamentals. The other thing too was COVID and federal largesse, both in Canada and the United States. There was a lot of money in sort of consumers' pockets that wasn't necessarily earned, but just came in the mail via check every month, and a lot of the service sector of the economy was slammed shut, right? COVID lockdowns were pretty slow to lapse here in Toronto and in Canada in general. And so I think people that might have otherwise gone to sporting events and concerts and casinos, made their own casino in the stock market. And so that has shifted 180 degrees. The free money from the government has been shut off. And the central banks are tightening the purse strings as well. We've seen very aggressive rate hiking campaigns on both sides of the border. There's more in store. And so, now you do have to do your homework. And so, what we are looking for are companies that cater to consumers' needs, not their wants, because in an environment where you can't have everything, which is 2022, unlike 2021, needs get
Yeah.
prioritized and wants go by the wayside.
Yeah, I mean, it is amazing the demand for, as you say, jet skis and hot tubs. I mean, we were all at home, right? So everybody wanted something fun in their household. That's for sure. I know we bought a hot tub anyway.
Well, and I'm
So,
sure it gets a lot of use. So these are good things, and they're durables, right? So you buy one and it lasts for 10 years or more, and so a lot of that demand got pulled forward for these hardline
yeah,
durables, and it created windfall earnings for a lot of manufacturers and retailers of these kinds of you know stay-at-home things like Pelotons and hot tubs and what have you.
yeah. That's right. Well, let's talk about then. It's interesting. So we're really going to be looking at stocks that people need their products. So one that you're looking at. Let's talk about the dollar stores. So Dollarama and Dollar General. So one Canadian, one U.S.
Yeah, that's right. So Dollarama, for viewers, I'm sure everybody knows this retailer. It's ubiquitous in Canada. It almost defines the dollar store category here, with about 14 or 1500 stores across the country. It's been public since about 2008, and it's just created tremendous shareholder value. It's up 8 or 10 fold since the IPO, and it grows
Mhm.
earnings through thick and thin at sort of a low teens to mid teens clip, led by 5 or 6% growth on the top line. That's driven by same store sales growth. They continue to find new ways to merchandise the store, new things to sell you. They add price points periodically, so it's no longer just a dollar store, but there's stuff all the way up to $4 and I think $5 now. And then they're opening new stores because the concept is not saturated across the country to the same extent it may be in the United States. They have operating leverage and they're very free cash flow generative, so they buy back their shares, and it all rolls up to a nice mid-teens growth rate. We think the shares are just a secular winner and undemanding valuation, about 26 times earnings. And indeed, they have been doing very well this year and are up 20, 25%, 30% year to date. So,
Wow.
we added it back earlier in the year and continue to like it. And then
26 times. I
stateside,
mean, that's a lot for a dollar store.
well, no, it's in line with where this company has traded historically. It gets a premium relative to other retailers because it grows more quickly, and it's really got the category almost entirely to itself. Now, if you look to Dollar General in the United States, it's the leader in the U.S. dollar store sector. It trades at 22 times because it's not as profitable as Dollarama, and it's got more competition, and it competes in tougher categories like grocery, where Dollarama doesn't really play. So they have different business mixes, but thematically they're on that trade down theme.
So, Brian, we're talking about owning retail stocks, where people actually need the product versus want the product. Let's talk a little bit about the grocers. Loblaws is one of the names that you like. I'm curious about that actually, in terms of almost the valuation as well. I haven't really been looking at this stock too much as of late, but why do you like it?
Yeah, I mean, we like it because it's Canada's leading grocer. It's got a scale and merchandising advantage over everybody else. They compete coast to coast across a variety of banners and formats, with the two primary competitors being Metro and Empire, which runs the Sobeys and Freshco banners, among others. And so grocery is a category where really you are catering to a consumer need and not a want. So that ticks the box for us, given the macroeconomic backdrop that we're expecting and indeed experiencing. And then the other line of business they're in is pharmacy. So pharmacy grows actually even faster than grocery, given aging and demographics and trends in prescription script counts across the country. And again, caters to a need and not a want. And I guess the reason why our team favors Loblaws relative to either Metro or Sobeys is in part the scale and procurement and merchandising sophistication advantage that having the number one market share affords them, but also their store formats over index to what's called discount banners. So I'm sure viewers of the show will recognize names like No Frills or Maxi in Quebec. These are discount format grocers. They sell a merchandise assortment that's substantially similar, if not identical, to what you get at a mainline Loblaws store, but the price point is in many cases 15, 20% lower. The stores are just a bit more bare bones, and maybe some of the fancy niceties like fresh sushi aren't necessarily going to be there, but your staples and your basic foodstuffs you're going to get, and you're going to get it at a better price. And that matters because when you've got inflation biting the pocketbooks pretty hard of consumers, as it is with inflation at 40 plus year highs, gasoline and food very prominent among the leading categories, burning up the inflation charts. People are looking for that value offering and make the substitute or the trade down from the full service banner to the discount banner. And they've just got more of it in square footage and store count terms than their big national competitors. And the other reason is their private label program is better than either of their two national rivals. And again, it's a trade down story. You can buy, the Frito-Lay potato chips for $3.99, or you can buy the yellow store brand kind for 99 cents. And people, again, when they're feeling the pinch on their pocketbook, will sometimes make that trade down. And so we think Loblaws is
Right.
uniquely advantaged relative to the other grocers for those reasons.
And what about valuation and what sort of dividends are they paying?
Yeah, so Loblaws pays a dividend. It yields somewhere between 1 and 2%. I think it's a little bit closer to 2% now. The PE
Yeah,
multiple
not a
is,
lot.
no, it's not. It's
Not,
not a lot. There's a share buyback, so there's a bit more return of capital to shareholders than just what the dividend would indicate. But there's ongoing reinvestment and into e-commerce and other initiatives like that, and store expansion to a certain extent, and rebannering stores and what have you. Um, and the valuation it trades, the exact number escapes me, but I want to say it's above 20 and below 25, with like 22, 23 times earnings, give or take.
hmm.
Um, So it's a
What's the
little bit
risk?
higher than it has been historically,
Yeah.
but not egregious.
But what's the risk in owning it? And in part to me, so many retailers are having obviously increased costs themselves on the inflation front, and really will they be able to pass that through to consumer? And at what point is the breaking point?
Well, so there's different categories of inflation that a grocer is going to face. So there's cost of goods sold inflation. So that's cost passed through from produce merchants and national consumer packaged goods, branded goods manufacturers like Kraft Heinz and Mondelez, Pepsi, Coke, and so on. That they're generally speaking able to pass through to consumers. And if consumers don't like the escalation in shelf prices, then they can always switch down to the private label, which advantages them. And then there's operating cost inflation. So there's not a lot of rent inflation, just given what's happening in bricks and mortar retail. There is wage inflation, and they are unionized. So that's one of the risks would be, labor strife. We're not
Right.
seeing that, but it is a risk to note.
Okay, we'll take a quick break. Okay, Brian, we've talked a lot about, you know, the needs, but, one of the names you also like is Aritzia, which, you don't need to go to Aritzia. But, it's amazing how well they have done, how well their concept, their brand, and their offering has resonated with the consumer year after year. And it's a nice Canadian company.
Yeah, that's right. This was an IPO, I want to say 2017. It was part of a crop, a spectacularly poor crop of initial public offerings that kind of bombed. Freshie was one of them, Ritz was another, and Aritzia came around the same time. And it stumbled out of the gate, but then found its footing, and it's been growing very nicely for the last couple of years. It was owned by private equity, and they wanted to monetize it and took it public a few years back. But this one is sort of a little different than the other retailers we've talked about because grocery and the merchandise offering at dollar stores is more needs based, and Aritzia is fashion and not basic fashion apparel either, but kind of premium fashion, not couture, but it's above, t-shirts and Lulus. And so, they've done a good job. The expression "fashion is fickle" is always in the back of my mind, and it's a risk you never want to lose sight of because a lot of these fashion retailers are on trend until they're not. But Aritzia seems to be able to manage their merchandise assortment very well and remain relevant to its core consumer, which is largely women sort of 20 to 50 age category. There's a store expansion thrust as well, a little bit in Canada and a little bit in the United States where it's an underpenetrated concept. So that's blue sky if they can get after it. And it's all rolled up to pretty robust earnings growth, and the market's recognizing it. And the stock's been performing quite well, and it's volatile, but it's trending upwards. And so it's a name we've owned for some time and continue to be pretty positive on.
And what's the valuation around?
So Aritzia trades around 26, 27 times earnings. So that is certainly higher than most of the other retailers that we've talked about. And it's warranted because it's got a better secular organic growth opportunity in front of it than most of them.
Right.
But it comes with incremental risks relative to these other retailers in a slowing economic growth environment. There's inventory risks, there's fashion risk, and there's even indeed, although I hate to even mention this, there's lockdown risk again if we have another one. Because
Right.
although they have an excellent e-commerce capability, there's a lot of bricks and mortar stores as well in their network.
Yeah. Well, hopefully the lockdown risk is not going to happen. I was actually talking to an investor in the States, and he said America will never lock down again. Like nobody will allow that to happen. People just
Yeah,
won't put up.
I'm inclined to agree with you. Having been down there myself a few months ago, I think they've had about enough.
Yeah, they've had enough. Okay, we don't have much time left, but I want to get to Alimentation Couche-Tard because I think a lot of viewers, a lot of Canadians own it or know the story. But why do you like it here? And I'm assuming all these names you would actually be comfortable with buying today.
Oh, for sure. Catherine, hold is not a word that's in our lexicon. If you wouldn't buy it today with a fresh dollar of new money, then there's no reason to continue holding it. So all these names we own and would be buyers of today for new clients. So yeah, Alimentation Couche-Tard has really grown up from its roots. One little convenience store in Laval 40 years ago, IPO 30 plus years ago, big network expansion, first in the US, then in Europe, now in Hong Kong. And so it's really among the largest convenience store operators in the world behind 7-Eleven, rapid grower in an industry that's not known for having high organic growth prospects. They've got procurement clout, which helps them price sharply on fuel that draws in traffic, brings people into the box, sells them higher margin discretionary items like gum, candy, hot dogs, cigarettes, beer in the US, and what have you, where they make 5 or 6 times the gross margin that they do on fuel. And they're excellent serial acquirers, identifying small and medium sized and even large acquisitions that they can integrate into their network, expand geographically. So it's a high teens grower and has been for decades. Great shareholder value creator.
Okay. And Brian, is there a dividend?
It's very minuscule, yields sort of 0.5%, give or take.
Okay.
It's,
Buying a
they do
grower.
deploy
Okay.
capital into deals.
Brian, we got to leave it there. Thank you so much for joining us, and thank you everybody for watching.
My pleasure, Catherine. Thanks very much for having me.